analysis of the situation in the Ukraine, in particular, how we feel about the actual situation on the ground and what the repercussions could be, and then also influence on the market. What kind of influence all this will have on the markets. This is a Not Even Wrong podcast. It's February 24th, 2022. This is Krim Delco. For today, the fund is up 4.3%. The market is up 1.5%. For the year, we are now down 28%. The market is down 10.7%. We're underperforming by 17.3%. So the situation in Ukraine, the way we see the situation in Ukraine is the following. And before I go there, I just want to put in the caveat that we are certainly not geopolitical experts, nor do we have expertise, technology, or any sort of thing to analyze the situation. But what we do have is a little bit of experience and connections. Actually, one of our partners used to work way back in the day when there was when the privatization of Eastern Europe happened and the voucher system was introduced. She was traveling around Eastern Europe talking to people, and one of those people actually is a very prominent investment banker today in the Ukraine. And while we haven't spoken to him directly, we have followed some of what he said, and therefore I think we have a little bit of a connection to the situation. Now, here's in general what he said and the way we interpret the situation. So this particular person said that the Ukraine has a very black and white choice to go ahead. One is either to clean the country in terms of corruption or to fall back into the arms of Russia. How do we interpret this statement? This statement tells us that internally the Ukraine is in a very bad situation. In fact, a very sick country because it doesn't have the institutions necessary to be a proper country. The repercussions of that, for example, have been very well, let's say, very questionable people to come to power. I remember there was a lady for a while running the country, and it was just bizarre, just the way she appeared and what she spoke about. But that's, of course, just the peak of the iceberg. What's really important here, I think, is just the fact that it looks like the main institutions, the army, the judicial system, the financial system, all these things that a country really is basically what a country is just a bunch of incentives around the border, and the incentives are driven by the institutions. It wasn't working in the Ukraine. Now, the repercussions for that was that there wasn't a real value-added system being able to develop. You couldn't develop anything in the country. For example, they don't have an investable stock market, and the stock market for us is always a good sign. It's not important to have a stock market in the sense that, yes, of course, you can invest in a country even without ever touching the stock market. You can go to Germany or Switzerland or France and invest in companies and become a very successful investor without ever touching public stocks. But the stock market is an indication for the institutional health of a country. If you don't have an investable stock market, you don't have an economy. This is basically the statement that we're making here, and that is the case in the Ukraine. Now, what does that all mean from the perspective of Vladimir Putin? The way we interpret this is that he actually has a choice to make, which is either clean up the Ukraine as an institutional country and strike a deal where the assets, in particular the pipelines that go through Ukraine to Europe, which are very, very crucial for the business of Gazprom, but also for the geopolitical leverage that Russia has to Europe, and also, of course, for Europe. These pipelines are somewhat controlled by the Ukraine, and if you don't have functioning institutions, then this causes a problem for Vladimir Putin. In a nutshell, what we're saying is that this whole charade about invading the Ukraine is about controlling those assets. And also from the perspective of Europe, this is a complicated situation because on the one hand, of course, Europe stands for freedom and certainly doesn't support the impact of, let's say, it doesn't support invasions from country X into country Y and those sort of things. But then on the other hand, absolutely, I would say that Europe also isn't interested in having its main gas supply being disrupted by somewhat questionable institutions that are hosted in the Ukraine. In other words, maybe Europe actually has an incentive to have a very strong hand controlling the Ukraine, because then you can have a fair negotiation where you sit on the table, you say, look, we need this, you have that, let's do the deal. Versus right now, it's kind of always up in the air because even Putin doesn't really control those pipelines. So in a nutshell, I think the way we see the situation is that Vladimir Putin is not interested in starting World War III. He's not interested in expanding his territory to the Soviet Union. Maybe not yet. Who knows what's going to happen in a couple of years? But right now, as we speak, the interest is simply to control the main assets of the Ukraine, in particular, the pipelines to Europe. This is the main interest. Once that's said and done, we believe that there will be some sort of mock election, some sort of reinstitution of institutions within the Ukraine in some sort of a semi-free way. The Russian Federation will have control, but not in a sense that this is an occupation and an enslaving of the people or anything like that. So having said all of that, now, how does this reflect in the markets? Well, we will have some turmoil, but overall, we believe that this will go away. This will be a situation, let's say, similar to situations in the past when there were invasions. Even the invasion of Ukraine in 2014 after the Sochi Olympics was kind of a similar situation, maybe not as dramatic. And I think the reaction in the markets is warranted because there's always a risk of escalation. But the main problem, of course, is energy prices. This is the key. And we have sanctions now instituted on top of onto Russia, and some of the sanctions make it more difficult for them to export energy prices. That's why energy prices are high. This is the main problem for markets. Now, having said that, we believe in the United States, now talking about markets and the economy, that we will have a recession anyway. So this is just going to accelerate our recession because we had peak inflation and peak rates that we announced that about 2 weeks ago, that we believe we have peak inflation and peak rates for very different reasons. The reason we think we have peak inflation and peak rates is that we believe now is the recession that we were supposed to have when COVID hit. We're going to pay for this now, and you can debate if it's better to pay now or then, or whatever. It doesn't matter. We will have a slowdown because we will have a double, triple, quadruple whammy of, on the one hand, the pandemic privileges going away, people having to go back to work, paying rent, all these things. Then also no more checks coming. And then on the one hand, and then also on the other hand, we will have a softening of the labor market because of less demand, and then therefore people will be even more inclined to go and find jobs and work and all those things. Wages will certainly not go up, and in that sense also things like rents and all that. So we believe that over the next 2 or 3 quarters, we will have a mild recession, not as strong. It doesn't have to be strong because here's what we think. We think that particularly the leaders of the economy, which is Silicon Valley, disruptive companies, innovative companies here and also elsewhere, but particularly in the United States, will actually benefit from this mild recession by having more resources, by being able to expand faster and develop the value that they already are providing even faster and at a larger scale. So in a nutshell, we believe this is, of course, good for Tesla, good for our CRISPR stocks, and in terms of fundamental economics. Now, of course, the actual situation in the markets is always a bit tricky. We're long stocks, we're not long the company, so we will have some draw. We already have a drawdown of 28%, so we already are paying a very steep price for that. We have a target downside for Tesla of around $600 a share, so there's potential for another 25% drawdown. Certainly in the cards. We are positioned to sustain that. We can sustain that. We certainly hope that it doesn't happen, but we believe that this is the downside in terms of when the washout would happen, if it happens. It might not happen. Maybe this is also sort of peak fear now. Let's see how that goes. We're not making that call right now. The call that we're making fundamentally is the following. The Ukraine situation will pan out. It will end up in a control of the assets and of particularly the Gazprom pipelines. This is the main reason why Putin wants to enter into Ukraine, control Ukraine. He doesn't want territorial dominance. He doesn't want to reinstitute 5 minutes. He doesn't want to reinstitute the Soviet Union. This is not empire building by Putin. This is simply the desire to control a very crucial asset, a very key asset of the Ukraine, and therefore also the repercussions for the country and for things like war and escalation are not that we want to play down the war or anything like that, but in terms of the market implications, to us, this looks like a situation that will go away, that we will have a very fast recovery from the fears of the Ukraine situation. However, we will then stumble into the mild recession that we are already expecting. We believe that that is in the short term going to cause some more volatility in the market. However, we believe that at some point when this recession is panned out and when the strong companies such as Tesla and the Amazons and the Microsofts of this world start benefiting from a softer labor market and more access to supply chains and better access to resources, when all of this is said and done, that we will actually see a better situation for those stocks and therefore a very sharp rebound. Now, having said all of that, I also want to finish this episode with one last thing, and this is the biggest risk we see. This is a big macro risk, and the biggest macro risk we see is the deterioration of institutions, particularly in the United States. Starting with the White House, the fish always stinks from the top. There is just an institutional deterioration in the United States happening on every level. White House, mayors around the country, states, all of these things. Unfortunately, this is part of the context in which this Ukraine situation is happening. In other words, Putin is doing this because we have a weak president, weak in not just as a person but as an institutional framework. It's weak. He's weak because he doesn't have decision power. He doesn't know. He doesn't have firm decisions. He doesn't make firm decisions. All of these things. There is no threat coming from there. I think our country is partly because of the pandemic, but also for other reasons, sort of stuck in the mud of partisan argumentations about things that are certainly important, but not uh, effective when it comes to building a strong global world order. And people like Putin are taking advantage of it. We don't believe China is in the same boat because China is part of the winning side of this global capitalist game versus Russia is not. Russia doesn't have the ability to compete at the same level like the United States, particularly Silicon Valley. China has some, at least, aspirations. Russia doesn't, so they're playing the other game, which is the tanks and the war game. And I think to us here in the United States, this should be a very strong lesson that we need to strengthen our institutions. We need to have a strong White House. We need to have a strong Congress. We need to have a strong judicial system. Partly, let's say, what's going on right now with Tesla and the SEC. And now I'm really tangential here, and I apologize for this, but I just want to mention this. What's happening with Tesla and the SEC is incredibly important. Because what Tesla and Elon Musk are alluding to is that the SEC really has been, let's say, for lack of a better word, in some sort of collusion with short sellers. This is certainly not the role of the SEC. And it's just another example of just the fear, even the idea that the SEC could be somehow used by the White House to harm Tesla because the White House has an agenda to fill, which is support the unions, help the car industry survive, all these things. Even the idea that we even can talk about this is already a sign that we have a deterioration of institutions, because the difference between the United States and Europe and the rest of the world is exactly that we should be able to trust our institutions, that we should not even think about such colluding, even corrupt actions like they're being now brought up by Tesla in terms of the SEC and the short sellers. And again, hopefully we can all sort this out. Hopefully we can use this as a pill for us to understand that we need to strengthen our institutions, because we have the best economy in the world, we have the best talent in the world, we have the best universities in the world, we can compete in the world of disruption. But what we don't have is strong institutions, and we need to absolutely work on that as a country and as a people. Thank you.